If you're someone who's looking to quit smoking cigarettes, or you have a friend that's trying to do the same, then I'll teach you a little trick that'll help you stay off the cigarettes. So as the old saying goes, I'm an expert in quitting smoking. I've done it 10 times now. So when I was on the cusp of my 40th birthday, I hitchhiked my way into Uzhhorod, Ukraine to meet some friends at a bar there to celebrate my big 4-0, and I was outside smoking, and about a minute to midnight there, and as soon as the clock struck midnight, I took the pack of cigarettes out of my pocket, I threw it in the trash, I snuffed out that cigarette, and I've never smoked a cigarette since. Now, if I pick up a cigarette tomorrow, I can't tell that story. So if you decide to stop smoking, do it around a particular date and have a story to tell, and that will keep you from wanting to pick up a cigarette again. And today's company is all about cigarettes. So the title of their investor deck here, responsibly lead the transition of adult smokers to a smoke-free future. Well, that doesn't sound very good if you're a tobacco company, because that's kind of your bread and butter, right? They say moving beyond smoking. So we're going to talk about what that means for Altria. And first, for those of you who are researching companies and are looking for free information that can be quite useful, then go to the credit rating agency. Sometimes they'll put out these reports like this one from Fitch on Altria, and it's simply excellent. So they talk about how Altria is an industry leader in the U.S. cigarette market, anchored by their Marlboro franchise. So I smoked Marlboros. I only smoked Marlboros. People who pick a particular brand are quite loyal to it in the tobacco space. They have leading positions in moist, smokeless tobacco, chewing tobacco, strong profitability and cash flow that benefits from good pricing power. That's all about people always having enough money to buy a packet of fags. So if you go around the world and into different, some of the world's poorest countries, you'll find that people always seem to scrape up enough money for cigarettes. If you're poor yourself, you'll find the same thing as I was. The constraint for Altria is that perhaps their biggest constraint is their over-reliance on the U.S. market. So you may say, well, I've seen Marlboros around the world. Indeed, they're sold in all sorts of places, and even have fake Marlboros in China, which you can very quickly detect if you're a Marlboro smoker. But that right to sell Marlboro actually belongs to Philip Morris. So other constraints for Altria, a secular combustible cigarette decline, so people just aren't smoking as much, and that will differ based on country, but in the U.S. there's certainly a decline. There's also uncertainties around this big strategy Altria has to shift to smoke-free products. So Fitch goes on to talk about how they need to maximize their cash cow, their Marlboro cash cow, and then reallocate resources to fund investments in smoke-free products. We're going to talk about that. There's risks around maintaining their long-term nicotine share, which we'll look at. That's in light of a very burdensome regulatory process, a heightened competitive environment, and uncertain consumer product acceptance. So Altria has lots of goals for 2028, one being that they want to double their U.S. smoke-free net revenue to $5 billion. Now, Fitch sees a potential downgrade to their credit rating, possibly arising from 4 factors they list here. First would be long-term volume erosion to base tobacco business. That's happening consistently, and it's a problem. If they're not able to offset that with growth in their smokeless segment, they're going to be in trouble. And people looking at that juicy 8% yield, there's a reason that exists. And in our experience over time, we've found that high yields like that don't stay that way very long, at least in respect to the dividend champions that we look at. And we're going to talk about Altria's champion status, or lack thereof. The other factor here, Fitch talks about an aggressive strategy related to M&A, going back to the need to grow smokeless products. Well, how are they going to grow without M&A? Well, they have one franchise we'll talk about called Enjoy, but that's not showing that much traction. They talk about adverse changes in regulatory environment So these are external risks that can't be controlled. Also, this reversal and litigation environment. So I came across this table in their 10K. I thought this was referring to thousands or millions or something, but it's the actual number of tobacco-related cases in various categories. So when you measure your lawsuits in the thousands, that means that you're operating in a very litigious environment with a dubious product, and indeed that's the case. So let's talk about Altria's Marlboro franchise. That's the leading U.S. cigarette brand for the past 45 years. Strong brand loyalty again. Marlboro smokers will only smoke a different brand if Marlboros aren't available. So Marlboro has a 58% share of the premium segment and around 42% retail market share, as you can see here, and they monitor that over time, something to pay attention to. This table here is measured in cancer sticks, not revenues. That's important to pay attention to, but the reason we're looking at it is to try to understand just how big their Marlboro business is. So 88% of the smokable products that Altria sells are cigarettes. The other 12% are cigars. 90% of their cigarettes are Marlboros. Now, what I thought interesting is just how dominant Marlboro is. So you look at these other premium brands listed in this table: Virginia Slims, Parliament, Benson and Hedges. Look how small a component those are of the total revenues there. Same thing with discount brands like Basic and Chesterfield. So Marlboro is truly a cash cow franchise for Altria. Now, when we look at oral tobacco chew, right? So it's said that if you chew tobacco, it's easier to quit smack than it is to quit chewing tobacco. So Altria has a couple pretty strong brands. Copenhagen probably being one of the strongest out there. They also have Skoal. And then this new brand On, which are these packets of oral tobacco. And what you see here really at that top table is potentially their On brand cannibalizing the other two. So their entrenched Copenhagen and Skoal brands are showing a decline in cans and packs sold, while On is showing an increase, and the overall number is on a decline. That's not good. Retail share performance, so market share for these products, you can see in the bottom there, of course, declining for Copenhagen and Skoal and increasing for On. That's not a surprise there. Now, what this translates to on the top line is just slowly declining revenues as people give up tobacco products for whatever reason. And what Altria has tried to do is acquire new growth, and they've failed miserably. And somebody should do a Harvard Business School case study on this. They made a $13 billion investment in Juul to accelerate what harm reduction, right? Going back to that title slide of their investor deck. And more importantly for investors, drive growth. It's really not worth anything anymore, and you can learn all about that disaster in a Netflix documentary called Big Vape, The Rise and Fall of Juul. But another failure so far, an acquisition that Altria made, or say acquiring ownership interest in Kronos Group, 45% ownership interest. And we see on this table the value of their current equity securities. So you see Kronos has declined quite a bit from the $1.8 billion they paid down to $335 million today. You see Juul there as a write-off, a wash. And then you have Anheuser-Busch, InBev, that's ABI. That's the majority of their investments in equity securities. But look at this. So a couple things to note on this table taken from Yahoo Finance. First is the amount of goodwill. So when they're going out and making those acquisitions, they're putting goodwill on their balance sheet. That's essentially worthless. One wonders if they won't be having some impairment charges coming off that massive amount of goodwill, $20 billion. But what I wanted to look at here is, see that $10 billion number? So that's just taken from the previous table. Look how it's declined to 8.4. So what they did is they sold some shares of ABI to buy back their own shares. So returning value to shareholders for Altria, that happens two ways: buying back shares and paying a dividend. Let's talk about dividends. So if you look at the past 5 years, you'll see this mid-single-digit growth. That's what they're targeting going forward annually through 2028, provided they can continue to do that. That comes down to payout ratio. We'll look at that. But you can see this looks pretty good. And everywhere, practically everywhere I look, I see people talking about this being a dividend champion. Well, we don't believe it is. And we have our own dividend growth investing strategy called Quantigens, and we license data from NASDAQ, and we've spent over a decade developing this strategy, and we've scrutinized the companies contained within our universe very closely. And we didn't include Altria because we don't believe they've consistently increased their dividend for over 50 years, as some say, which would make them a dividend king. So they're not a dividend king, and they're not a champion, because you can see here on this chart the decline that happened around 2008 in their dividend. This relates to spin-offs and such. This stuff gets very complicated. That's why we can validate our findings against the experts over at S&P Global, who also believe that this is not a champion, what they call an aristocrat. So S&P Global, the difference between a champion and an aristocrat is that an aristocrat belongs in the S&P 500, or it exists there. And S&P defines an aristocrat as a champion that also belongs to the S&P 500. So because Altria is in the S&P 500 and not classified as an aristocrat by S&P Global, that tells us that this is not a dividend champion. So it validates our own findings. Regardless, I thought that was, we get asked this question a lot relating to our strategy, so I thought it was worth a slide. But when we look at how cash gets returned to shareholders by Altria, table on the left here shows the billions returned over the past 5 years. This is pretty intuitive. This is free cash flow. What are they going to do with that? Well, they'll return it to shareholders. So take 2023 as an example. You see they took that $7.8 billion in free cash flow. $1 billion was buying back shares. 6.8 was paying dividends. Since they're going to be increasing those dividends over time, they need to have at least $6.8 billion in free cash flow to pay that. Of course, they can, incur debt. They have some cash, I think $3 billion. So they have some buffer there, but they need to keep this free cash flow increasing if they hope to continue increasing their dividend. And you can see in their goals, of course, they have, growing earnings per share at the mid-single digit, which of course translates to mid-single digit dividend growth as well. And they have this goal here: enter non-nicotine categories with broad commercial distribution of at least 5 products by 2028. Well, nicotine is the whole value proposition, right? That you get your customers addicted. You see people that quit smoking, and what they'll do is they'll move over to the gum, and then they'll realize how expensive the gum is, and then they're back on the fags again, right? So anybody who's trying to quit smoking needs to completely avoid nicotine. No patches, no chew, no gum. And that's how you get off of an addiction, right? So the fact that they're going into non-nicotine, it isn't really appealing objectively, right? And they again talk about their desire to double their U.S. smoke-free revenues by 2028. And one of the leading products that they tout, if you go to their most recent deck, I think a third of the deck, this is their quarterly investor deck, talks about this Enjoy vape pen. You can see here consumables and devices, the number being sold this last quarter versus the quarter in the year prior. You see the numbers down. That's not good, right? But we like the consumables aspect of this. But when we look at e-vape, so this was taken out of their 10K. They say e-vape category grew approximately 35% in 2023. Well, that's great. But it was driven by illicit flavored disposable products, which currently represent over 50% of the e-vape category. And their vape pen, if you will, that only has a 3.7% market share. They said it represents less than 1% of their 2023 revenues, or less than $205 million. That's hardly anything. We know that in 2022, estimates say out there they had $150 million. So this is just very small relative to the size of this company. It needs to grow a lot. And when we look at the battles that they're facing, for example, they're trying to push the FDA to enforce actions against companies that are importing illicit e-vape pens, and they actually track that in the investor deck, and penalties are issued for unauthorized e-vapor products that are sold. So they're having to do some of that work themselves, but there's also legitimate competition to be worried about from the likes of Philip Morris. So some bits here of interest. They have full rights to commercialize IQOS, which is another vape product franchise, beginning in April of this year, following their agreement with Altria to end the commercial relationship relating to that. So Philip Morris actually has a strong record of IQOS launches in international markets, in 17 markets, and more than 50% of the revenues generated from smoke-free products. So they have to compete against illegal products and legal products, and it's going to be tough. Now, just some concluding thoughts on Altria. 81% of their profits come from that Marlboro cash cow, which that seems to be fairly well entrenched. But this is also a highly regulated industry, and they're being attacked by lawsuits left and right. There's a lot of variability there, uncertainty. Their core product, cigarettes, is declining in usage, and they say that's by design. Well, they don't have much of a choice, do they? They've had horrible attempts at trying to expand in the past, just blowing through, around $20 billion in cash there, nearly. They have a heavy debt load. Of course, that's offset by their ABI shares. But what growth potential does this company have? Can they acquire growth? And if so, how? So just remember, when you eyeball that juicy 8% yield for Moe's stock, that there really is no free lunch. So I'm going to go ahead and leave you with another video on dividend growth investing that I'm sure you'll find very interesting. Please make sure to subscribe to this channel. Thanks so much for taking the time to watch this today.